SoFi stock is down 11% in the last month, and it's down year to date in 2025. And some investors are asking me, why is SoFi stock down, and is it a buying opportunity at the current share price of around $14 a share? I'll answer those questions in this video here by explaining the reasoning why the SoFi stock price declined and sharing with you my discounted cash flow valuation model for SoFi stock, which I updated today with the new intrinsic value per share number that's higher than where it was when I did the discounted cash flow uh, more than a month ago, I would say. So I did give it an upgrade in intrinsic value per share today, and I'm going to share that with you in this video and answer if I think this is a buy at the current price.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So here's a price chart. SoFi stock over the last month down 11.3%, even though it's up over 1.5% today in trading. You can see it's down primarily since February 18th. And you'll notice that when the overall market starts to decline, SoFi stock experiences a greater decline than the overall market. That's typically the case with companies that have a beta over 1, and SoFi stock has a beta of 1.79. So it's a relatively high beta. And what the beta measures is a stock price's performance against the S&P 500 index. So a beta of 1 means that over the last 5 years, when the S&P 500 has moved up by 1%, the stock has moved up by 1%. A beta of 1.79 means that SoFi stock price has been 79% more volatile than the S&P 500 index. So when the S&P 500 index has moved up by 1%, SoFi stock has moved up by 1.79%. In other words, it's a measurement of riskiness of a stock. The greater the volatility, the greater the riskiness. And so that's why when the market moves up, SoFi stock likely moves up faster than the overall market, and the same thing on the downside. It's not always the case. This is a generality, and there are more factors that play into SoFi stock rising or falling. But just in general, the correlation to the market has been about 1.8 or 180% of the market's volatility. And of course, in the last week or so, the market's been extremely volatile. You've heard a lot of developments coming from the administration here in the United States on more tariffs. And tariffs are typically bad news for an economy because they increase uncertainty. They increase costs for businesses to import products, and they also increase uncertainty, which does not help with planning. If you're a business, you're trying to plan for your next product launch or your next fiscal year. You're trying to determine at what price do you sell your products, how much do you produce, where do you produce them, where do you ship them, do you open new locations, do you hire more people, do you fire more people? All of that takes a lot of planning and foresight. And when the administration is changing things seemingly every week and every month, it makes it very difficult for businesses to plan. So what they do is some of them just take a wait and see approach. They just say, let's delay these plans, let's delay these new projects, let's delay these new hires, let's delay as far as we can so that we can get more information so that we can make a more informed decision. And so those prospects are leading to a less optimistic outlook for job growth and for U.S. economic expansion in 2025. And SoFi is, like I mentioned earlier, very highly correlated to the broader economy. The company makes loans. It has billions of dollars of loans outstanding. And if there should be an economic slowdown, SoFi is going to be hit very quickly during that economic slowdown, because not only does it make loans, it makes loans into the riskiest part of the segment, which is personal loans. if you're an individual or a household and you have, let's say, 5 different loans, you have a car loan, a student loan, a personal loan, a home loan, and credit card debt, one of the first things you're going to default on is your personal loan and your credit card debt. One of the last things you're going to default on is your home mortgage and your car loan. Because if you miss your car payment, the company can come and repossess your car and you don't have any more transportation. If you miss your home mortgage payment, they're going to foreclose on your house and you're not going to have a house to live in. And so one of the first things you default on is the personal loan and the credit card loan. And this personal loan category is one where SoFi has the greatest exposure to. Over $20 billion of the liabilities on SoFi's balance sheet are personal loans. And so that's why SoFi right now has experienced this greater decline, is because of the uncertainty in macroeconomic growth and SoFi's position in correlation to that macroeconomy. SoFi benefited when the economy looked better than expected, and that was the case for all of 2024. There was a lot of fears going into 2024, but the economic growth for that year, for last year, was much better than expected, and SoFi benefited as a result. And now we're seeing similar fears again starting 2025. Now, job growth has still been strong, economic growth has still been strong. So, this is mostly fears of what will happen or what could happen based on these latest developments and these latest policies. And so, they're not yet actual results, but the market is a forward-looking mechanism. And when prospects look worse for the near term or for the long term, it gets incorporated into the price relatively quickly. So that's kind of my explainer why SoFi stock is down in this last month or so and is down for the year, while the broader market has performed relatively well on the year. So now let me get to answering if I think it's a buying opportunity. So SoFi stock is now trading at a forward price to earnings of 30, which is near the lower end of where it's traded for in the last year. So it's about where it was a year ago. But the business is much better than it was a year ago. SoFi has grown quite nicely. It's added new members, it's added new products, it's added profits, it's added cash flow. The business is expanding nicely. And the business is now a larger percentage of its revenue is coming from non-lending sources, which makes it less risky, right? The more lending SoFi does, the more risky the overall business is, because lending, like I talked about earlier, people could default on their loans and that will hurt SoFi one way or the other. I know you're going to say, well, SoFi sells a lot of their loans to third-party partners, which has been a great business for SoFi. That's helped the company a lot, is that outside companies are looking to buy the loans that SoFi is originating, and that's been great news. But if the performance of those loans start to deteriorate, then demand from those third-party companies to buy those loans from SoFi will also decrease. So it's still exposed to the risk of defaults from the loans that it originates. Whether it keeps them or whether it sells them, it still has some exposure to those loans. So it cares, and it is dependent on the performance of those loans. And so as the business becomes more diversified and less dependent on loans, that's a less risky business. And that's primarily what's happened over the last year. SoFi's financial services and tech segments are growing nicely and taking a larger percentage of the company's overall revenue. So you're getting a better business, and you're getting it at roughly the same price a year ago in terms of the forward price to earnings. Now, I talked about my discounted cash flow valuation, which I just updated today. The intrinsic value per share I upgraded. Previously, the intrinsic value per share I calculated for SoFi stock was around $18, $19 a share. And today I upgraded that. It's now, my intrinsic value calculation now has the stock at $23 a share. The current market price is $14.30. So whether I look at SoFi stock from my DCF perspective or whether I look at it from the forward PE perspective, SoFi stock looks undervalued. And the company's growth prospects look really strong. I like the business it operates. I like the strategy it's taking to capture this market. I think a digital banking strategy is the smart strategy for the banking industry. It's oversaturated with brick and mortar locations that aren't serving customers very well. These brick and mortar locations are not staffed adequately, both in terms of number of employees and the training of the employees that are in these banks. And so that's provided an opening for SoFi, which it's stepping in really nicely and taking market share. And I expect that to continue because what I'm hearing from those other legacy banks is they continue to shrink their presence in those locations. So they're not capitalizing on their brick and mortar locations, which could be an advantage for them, but they're not investing in them properly or adequately, in my opinion. And so that's an opportunity for SoFi longer term. So to update my recommendation, I've had SoFi stock rated as a buy for about at least 6 months now, maybe longer than that. And today I reiterated that recommendation. I updated it along with my intrinsic value per share. I still like SoFi stock, and I do think it's a buying opportunity at current prices. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.